Hi everyone and welcome to this YouTube channel. In this video, we are going to talk about how to survive an economic recession. So before starting this video, please like this video and subscribe to our channel for future updates. Manage financial stress, recession is in the air. Whether we admit to it or not, signs of an economic slowdown are around us. We could argue that India will be immune or not. We could debate whether the West will be more impacted than the East. We might indulge in speculation about the dollar and oil, but our circle of control is what needs action, not the larger circle of concern that involves all these macro questions. First, prepare for risks to your regular income. The degree of impact may vary depending on the sector you work in, the strength of the firm you work for, the elasticity of demand for your goods and services, and many other factors you don't control or cannot realistically estimate. But a drop in demand for products and services can mean low or no increment, cut in pay, cut in job role, or loss of job in the extreme. Do not be reckless about changing your job or seeking new roles. Stay with the tested waters when the going is tough. New jobs may be difficult to find. If you can supplement your income with other moonlighting opportunities or part-time work opportunities, pick them up before job markets get into a deeper slump. Postpone decisions to quit or to take a break. Retain multiple earner status for the household. Second, do not fish in muddled waters and try to make investment decisions you risk considering as smart. This is not the time to speculate on the dollar, oil, or gold. You will risk buying at the top and holding on through a slump and make yourself no money. During a recession, businesses do not make capital investment decisions, nor should you. Do not buy real estate because someone told you that property will never lose value. Be aware that many assets are inflated in value when demand is high and interest rates are low and will fall steeply when those conditions reverse. Third, business failure is a common occurrence in a recession. Weak businesses are at higher risk and new weaknesses will show up as the situation gets worse. Do not speculate on stocks and on unknown names. Keep off IPOs and small cap stocks and set aside the temptation to think of a new name as the next multi-bagger. Stick with the known and established names that will likely remain standing during tough times. Large cap stocks and funds are better avenues during tough times. These days, it's easy to experience anxiety and stress around the future of the economy. The latest bout of inflation is causing high price tags on essential consumer goods to skyrocket. News headlines are filled with recession speculation, bear market fears, and interest rate hikes. Things are costing more, says Amy Hubble, principal investment advisor at Radix Financial. People are starting to feel it more, they're spending more at the grocery store and more at the gas pump. That puts anxiety in people's heads. But business cycles consisting of periods of growth and contraction are normal and have been observed time and time again throughout the country's history. The U.S. has entered a formal recession 14 times since the Great Depression. Recessions have lasted an average of 17.5 months historically, with the most recent recession occurring in February of 2020 and lasting only 2 months. To manage your financial stress, educate yourself about business cycles and make a plan to weather this and future downturns that are an inevitable part of any economy. In the end, Hubble says the long-term effect of a recession on most consumers is minimal. Change the way you spend. With a recession looming, it's time to review your budget. Start by reviewing how your expenses have changed over the last year to determine where cuts should be made. A recession is something your financial planner should have already accounted for, says David Ray, president of DRM Wealth Management. You might make small adjustments like if your rent goes up 30%, but those are adjustments rather than drastic changes. During the Great Recession that ended in 2009, consumer spending experienced its most severe decline since World War II. According to Pratik Chintagunta at the University of Chicago Booth School of Business and Shursho Biswas at the University of Washington Foster School of Business, research indicates consumers tend to shift spending away from non-essential categories and often become more price-sensitive during recessions. But exactly how individuals will be affected by a recession and rising prices varies. The Great Recession was particularly painful in the young poor and middle class, Chintagunta and Biswas wrote in an email. But not all consumer groups responded equally in terms of changes to their consumption behavior. For example, they note food and home expenditures went up disproportionately more for older, more educated, white and Asian households, and younger households switched more to warehouse clubs, whereas older households switched more to discount stores. Review your asset allocation. Investing during a recession can be scary, but experts suggest that sticking to your investing plan during an economic downturn is critical to its success, and retreating to typical safe haven assets like bonds comes with risks. There's a cost to safety, Ray says. You don't lose money when the market goes down, but you don't make money when the market goes up. Investors have a tendency to panic when their portfolios take a significant loss. But imagine selling all of your equity assets during the early days of the coronavirus pandemic just 2 years ago, and missing out on the subsequent market rise that followed. The latest market slump can be viewed as an opportunity, Hubble says. If I had any cash left, it would be in the market, she says. Reduce variable rate debts. Though minor changes may be made to your investing strategy, major ones may be made to your plans to borrow debt or pay off existing variable rate loans. Whether you are in an expansion period or a recession period, you really don't want to change your activity towards saving and investing, Hubble says. You may, however, want to change your posture towards spending and taking on debt. As the Federal Reserve seeks to tame high inflation, it plans to continue raising interest rates. Higher interest rates make it more costly for individuals to borrow money and make variable rate loans like credit card debt to become more expensive. Take another look at your existing debts and consider paying off those with variable interest rates. If you're seeking to become a homeowner or take on any other major debts, consider delaying these purchases or adjusting your budget to accommodate the greater expense associated with borrowing today. Plan for a possible job loss. During recessions, the unemployment rate typically rises. Take a moment to consider your own personal risk and plan accordingly. How likely are you to be one of those people losing your jobs? If you're a realtor or mortgage broker, for example, things could be tough going forward, Reese says. Work to make yourself more valuable to your employer while dusting off your resume and keeping an eye on other job opportunities. In the worst-case scenario in which you do experience a layoff, having already built up an emergency fund of, at minimum, 3 to 6 months of expenses saved in cash is key. In a recessionary situation, the biggest risk is that you could lose your income, Hubble says. So you want to have cash on hand to make sure you can weather a loss of income. Thanks for watching.